It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
And welcome back to another episode on this weekend. Yes, we're talking property news 7 days a week, even on a Saturday morning, as heard on iHeartRadio, Spotify, Apple Podcasts are there, as is Amazon. Great to get into another weekend. December the 7th today. If you're looking at property, good luck. As we know, Australia's property market is slowing, with CoreLogic's Home Value Index rising just to 0.1% in November. Now, that is the weakest result since January of 2023. Major cities, as we know, like a Melbourne, like a Sydney, are leading the downturn, with Melbourne values down minus 2.3% annually. Perth remains the standout. We keep talking about that. Values up 3% for the quarter. And around the rest of the country, growth is moderating, reflecting a broader cooling across capitals and regional areas. So on our Saturday morning, let's catch up with Anthony Landau, the Managing Director and Mortgage Broker at Equilibria Finance. And Anthony, as I mentioned, the downturn, it's very much real, and no doubt you are talking about that downturn in Sydney particularly with your clients.
Yeah, good morning, Craig. Great to be here. It's an interesting shift. At the beginning of this year, we were talking about it being a seller's market. Now we're talking about it being a buyer's market. It's been a big 12 months, and as you said, we've got a little bit of an easing. We've got a downturn. Nationally, the last 12 months growth was at 6%. Nationally, the last 3 months it's dropped to about 1.1% or so, as you said, and we're in fact seeing negative growth. Sydney's slowing to a standstill, virtually 0.1% over the last 3 months. Perth's annual growth's over 20%. Adelaide's over 15% and Brisbane over 13%, and that's coming through in the data, and it came through in how spring played out as well.
Now, I spoke to Margaret Lomas earlier in the week, and we were talking about borrowing capacity increasing for next year. You know, this is going to be such a hot talking point, because as the interest rates come down, everybody, particularly the likes of yourself there as a mortgage broker, talking about the borrowing capacity. And I gave Margaret this example of how 50 basis points reduction can be a rather large number for those couples in the 150k plus bracket. But as she said, you know, not every couple is going to have the same borrowing capacity. I thought that was a good point to make this morning with you, because you do all of the numbers in any couple, in this case 150 plus bracket, and you go through how they're spending, and that really does sort of play out in the final number that they can borrow.
Yeah, it's a good observation. I think we will, at some point next year, maybe the second half of the year, starting to see some rate easing. It's not as simplistic as saying, look, everyone's capacity will suddenly increase by X, Y, Z. It will help borrowing capacity, but there are other factors. There's inflationary pressures. The rate of inflation was outrunning wages. There's people wages growth. There's what are they spending their money on as well, discretionary expenses as well as other expenses. So yes, it will help purchasing capacity, but we do have to remember it is case by case. There's going to be other factors that overall influence what people can borrow. But overall, I think as a general comment, it should assist people with their borrowing capacity.
And here's just another question on that. Have you got clients that have sort of done the maths with you and said, right, let's just hold the trigger in terms of buying a property. Let's wait until 1 basis points, I mean, that's 25 basis points, 4 of them. Are they going to be sort of waiting for that 1 basis point to come down, because that will get them into the desired sort of price range and property that they're looking at buying?
Yeah, that's absolutely influencing the market. We've got some subdued buyers out there, and we're doing some simulations and some maths for clients saying, look, after one rate cut, this is what your capacity looks like. After two or after three or even after four, as you're suggesting, you can borrow an extra 200,000 or 300,000 or 50,000 or whatever the case may be. So we're absolutely looking at that sort of simulation, and people are comfortable focusing on their deposit, waiting for the rates to maybe come down and then leverage back in the market. Bear in mind, that might also drive the prices up as well if demand comes up. So it's very hard to time the market, but yeah, we have got people waiting and we're doing some simulations for them along those lines.
You know, we've had the vendors pretty much being in the box seat, and with what you've just described, that is now a buyer's market situation, a buyer's scenario situation. They're now comfortable just holding off, looking at your comparisons and going, yeah, we'll just wait this one out.
Yeah, and we saw that in spring. The rate of growth is slowing. And spring, essentially, one of the busiest times of years traditionally, became a buyer's market. Stock was up 10.6%. Vendors were essentially hoping to still capture some of those historic prices. They weren't capturing them. Stock was on market 32 days. It was at 27 days last year. So essentially we saw, for example, in Sydney sales were 15% lower than the 5-year average, and that's quite significant. Stock's up 10%, so it's up and around where it normally is, but the actual sales growth, the clearance rates, is 15% lower in Sydney than the 5-year average. Buyers are having more time, prices are not holding up as much, so yeah, we have got a trend towards a buyer's market. If they do wait out 6 months or for the first or second rate cut, that may stimulate the market again and we might see a bit of growth come back into the market again. But right now, it's been pretty subdued, and that was reflected through spring.
Yeah, so some very interesting comments around all of that. When we come back, we'll talk about the behaviour changes and the sentiment and what is driving that market. We'll talk all about that next.
Unlock the secrets of real estate and stay informed about the latest real estate buzz with hot market trends, emerging suburbs, and hidden gems.
But one thing is for sure, once that buyer has lost out, boy, are they ready. I mean, you've got yourself a very good buyer now, because the minute something else comes on, they will go for it.
All corners of the globe are being attracted to the Dubai property market, because I saw some numbers recently that was talking about units. It's a massive, massive number, and you're not going to be able to sell any of that stock unless your migration is operating at the level that it is right now.
So you're right. At the moment, we're handing over between 30 and 40,000 units every year, but soon that number could go as high as 180-odd thousand units. Now, when that happens, it'll be the rents that will start to soften first. But honestly, Craig, I don't think we're going to see that until probably 2027 at the earliest.
Each week, we bring you in-depth real estate discussions, including inspiring stories from homeowners, knowledgeable real estate professionals and economists. Whether you're a buyer, seller, or just a real estate enthusiast, we are your ultimate property podcast.
And it is a Real Estate Saturday, another weekend, very much getting closer towards the end of the year. Anthony Landau is with me, our mortgage expert guru. And Anthony, what were some of the major factors driving market sentiment and behaviour changes if we have a look across the 2024 year?
Yeah, there were some main influences. We sort of touched on the main one, I guess, with interest rates. The cash rates held essentially over the course of the calendar year at 4.35%. That has definitely had an impact on buyer behaviour. It's had an impact on capacity, as we've just been discussing. It's also had a bit of an impact on, hey, maybe now we start thinking about holding off until next year, which has actually subdued our growth, which we've discussed. Population growth was a big driver, particularly earlier in the year. It was a big driver in demand, not only in terms of the housing market, but also the rental market. Our rental market at the beginning of this year was vacancy rates below 1% in a lot of areas. That's eased up a little bit, but population growth had a big influence. Supply shortage, we've got this chronic supply shortage. It's here today. It was here at the beginning of the year. It's going to be here next year. A couple of other maybe ones that people haven't thought of quite as much. Construction costs have gone up. People might be holding up on construction, or prices of construction have gone up, so people can't do exactly what they want. There's inflationary pressures around construction. The regulatory environment's not getting any easier in terms of helping with supply of units, helping with supply of stock, and inflation's remained persistent. So those are the main sort of factors that have influenced affordability, influence what buyers can do, and also influence some of the psychology behind their decision making, whether they're investors or owner occupiers.
Yeah, there's a lot of psychology, of course, when you're buying property. And this year, I think people's minds have been going left and right. Next year, 2025, let's look ahead at what key trends and perhaps investor activities might shape the market. Anybody's guess, but what are your thoughts?
Yeah, look, and I think psychology is playing a big part at the moment. There's an easing pace of growth. A lot of people are sitting on their hands waiting until 2025 when we might see some rate cuts. So buyers are essentially holding up. So what we're possibly going to see is a slow start to 25, then maybe around the second half of the year with some rate cuts. We might see an increase in demand. We might also then see some more stock come on the market. We might actually see the rate of growth increase in that second half of 2025. So it might be a fool's paradise waiting out for 25, because we might see, yes, affordability's going up or improved, serviceability's improved, but prices are also getting driven again with that extra demand. We're still going to face our supply constraints next year. There's no silver bullet there, as we've discussed. There's a chronic undersupply. There's construction challenges. But I think the big thing is going to be these interest rates and how people come back into the market and when they come into the market. Are they going to sit on their hands, or are they going to get up and about early in the year to try and capture that subdued market? On the investor front, investor credit flows are up 29% over the last 12 months. So investors are starting to see investor-grade properties back on the market. They're looking in Adelaide, Perth, Brisbane. They're looking at getting some of that capital growth. So investors are up and about, and I think that's going to continue into the new year after a very, very subdued couple of years for investors.
So that is the 2025 year. The one thing that was missing in that bit of commentary, Anthony, was the trade tariffs, what America are going to do, what Donald Trump is going to do. And that, of course, remains to be seen. But that is a bit of a forecast, a bit of a look into 2025. Hey, have yourself a fantastic weekend. Look forward to chatting one more time, I think, before we sort of break over the Christmas period.
Yeah, well, the RBA meets on the 10th, so that's next week. And then, yeah, we'll get together one more time before the end of the year. The year's starting to slow up a little bit. Sun's out. It's a good time of year.
We connect you to the best real estate information across Australia. The Real Estate Podcast.